Hello, everyone, and welcome to the Upside Ticker Talk. This is our 10th episode, and it is March 18th. We're super happy to be back in studio. March break just ended. I know it's still March break, maybe in certain places in Canada, but we're back here. The snow's melting for myself, anyways. Golf fan, and it's starting to look pretty good outside. So excited about that. Before we get to our special guest today, I wanted to share with everyone, we're going to try to maybe do this at the beginning of some of the shows. If there's any notable news in terms of content that we're producing or new things that we've put out on either YouTube, our website, just to share some of that with you guys, you can check it out as well. And the one thing I wanted to highlight today is we actually just launched a series of French and English videos for each one of our all-in-one ETFs. Those were done by our two very talented folks here at Fidelity, Sébastien Fauché, an ETF strategist, and Audrey Kim, a senior product analyst that we have here as well. And just to give you a high-level overview of those portfolios, if you want to get a better understanding, check those out on YouTube. Joining us today, Frederic Viger, Managing Director and Co-Head of Institutional Sales, ETFs, Electronic Trading, and Equity Derivatives at National Bank. It's a mouthful, but it's a nice title. Fred, thank you so much for joining us. This is awesome. And I know you're not too far away from our studio, so we're very glad you could make it out. But
thanks for having me.
No, it's going to be fun. And we're going to take a deep dive into all things market making, because that's really kind of what Fred's specialty is. Obviously, we're going to bring in a bunch of internet questions as well, like we always do. Make sure that you guys learn a lot of things today. And every time I either work with Fred or with Patrick, his also counterpart who we've had on the podcast before, I learn something new every time, so I'm sure you will as well. And before we get to the meat of the episode, just a quick recap of our last one that we did. It's also available on all podcast apps on our YouTube. We hosted Jacqueline Power, who's our Director of Tax and Research. It was right around tax season, right? Or it's the beginning of tax season, which we're still well into right now. But just providing some insights on the different types of distributions you can find in ETFs, the difference between return of capital and just capital gains. I know there's still, some people often see ETFs with very high distributions and don't realize that maybe their NAV's being grinded away. So we try to elaborate and go through all of that and make sure that everybody's well prepared for tax season. So let's get right into it. First segment, as always, update of the Canadian ETF industry in terms of flows. And, I take credit for naming the bullet points, but it's actually Fred's team that provides all the data to us. So we're always happy to have that month-end report. I guess I'll start off with very positive note. End of February, $19.5 billion of ETFs going in for the month. Slight little slowdown we've seen over the last 2 weeks, as is kind of the seasonal norm, if you will, as RSP season wraps up, as well as obviously now we're seeing a little bit of volatility in markets due to ongoing kind of clash, if you will, in Iran. But that being said, very good month in April. Led the way by equities, about $12 billion of assets going into the equity side, more than half of that $12 billion going into international equity ETFs, which is a trend that's really been growing over the past 12 to 13 months and has had a little, couple relapses, if you will, last year as U.S. equity markets recovered post-tariff pause. But nonetheless, it's really been a dominant theme among Canadian ETF investors over the past year. A couple other things I noted down here. First of all, in terms of sector ETFs, which I know a lot of advisors, a lot of investors still love very much. We actually saw a lot of outflows from financial sector ETFs, and obviously those heavily dominated primordially by kind of the bank ETFs that we have in Canada. Love our banks. But you saw inflows go into the energy sector, which is almost interesting because it was slightly before we saw actually oil prices go up over the last couple of weeks. But nonetheless, some positioning being done there. In terms of fixed income, a little bit boring, but about $4.6 billion in February. But it was really kind of dominated by a few very large institutional sized trades. So it seems like both on the direct investing side as on the advice side, really not much appetite to be adding to fixed income right now, which I guess has proven to be a somewhat diligent approach as yields have risen over the past couple of weeks as inflation worries rise again. The last point I'll make, multi-asset, and Fred, I'll finally give you a chance to jump in here. Multi-asset, where our all-in-ones fall. And that's really where we've carved out a pretty nice niche for us here at Fidelity Investments. That category has had, since it's existed anyways in the reports that we get from you guys, I don't think there's been a negative month of inflows or outflows, I guess I should say. And I think it was a record in February at 2 billion, or maybe the second best month after January. So don't hold me to that, but really good month at 2 billion. And obviously 2 of our ETFs falling into the top 10 for the month, with FBAL, our all-in-one balance, at 4th, and our all-in-one equity at 6th position. So very happy with that. And thank you so much for your support. We absolutely love it. So with all that said, Fred, is there anything in there that like stands out to you, whether it's, something that might be a bit different than what we saw, say, in previous months or year, or, something that caught your eye, basically?
Well, obviously, we are the biggest ETF market making desk on the street in terms of market share. And we do need to go back and look at these stats, because on a daily basis, we might be trading tons of covered call ETFs and a lot of equity-based ETFs, and not too much of fixed income. So the bulk of what is traded is against our algos or programs that actually post a bid ask out there. And then we have the bigger institutions or the bigger retail advisors that need for us to provide liquidity to put up a block. So at the end of one day, or at the end of 1 week, or at the end of 1 month, I mean, we do have these figures in mind where we think we know where the flows went. Like it was so obvious back then when during COVID or right after COVID, a lot of the money went to the cash products, or a lot of the money went into your all-in-one products. Yeah. But we do always need to look at these stats. I would say in the last maybe week or so, 2 weeks, we were expecting PMs and institutions to do more rebalancing, like more TAA out of bonds into equities and stuff, but we haven't seen that really. And I think it's because, even after 2 days of US bombing, the market was still flat. Yeah. So basically, I think people are waiting to see how long it will last. And now, maybe after a week, when you realize it might take a bit longer, now you start seeing people, okay, maybe we'll sell out of this and go more like prudent. Yeah. But it did take a good 2-3 days, So in terms of flows, we were expecting more repositioning, definitely.
More moving around. And I think, like to your point, it's kind of like everybody's just like stood back, took a deep breath, like let's figure out what this means for certain narratives, or we, is there a trade to be made, or so I think it's interesting you say that, because you tend to see, anyways, historically, but it's not all the case, but it's rare that we're generally more reactive as investors, right? So you see something, that this is starting to work. And I think another good example, I didn't mention it here, but demand for spot gold last year, right? Gold has been going up since mid 24, and then last year is really when the flows seem to pick up. Everyone's been calling
the top for a full year now. So where is it? Are you too late in the trade? So it's.
Well, I mean that's great, and thank you for the insights. It's always one of my favorite days in the beginning of the month, when I get all the different notes that you guys send us out, and it's truly useful, and I think
they do a really good job.
Really good job, and for us, we try to bring that into the conversations from an asset mix perspective, like, hey, this this is what other people are doing, like, have you thought about this and that? So it's very useful in our conversations in our world with advisors. So yeah, all right. Let's get to our second segment, answering the internet. So we're going to take your questions, and thank you again for submitting all of them. We actually got some really good ones, and actually some ones that are like perfect for the guests that we have today, I think. So we're going to try to answer as many of them. We're going to do like 3 to 5, depending on how long Fred and I kind of go at it. But the first question, Fred, I'll throw your way is, how much human intervention is involved in professional market making, which I thought was a really good question from one of our audience.
Yeah, true. Obviously, I think I know why the question's being asked.
AI. No.
But to answer it professionally, there's a lot of human intervention, I would say, in the morning when the traders take all the PCFs, like it's all the data that's provided by all the ETF issuers. They take all this data and they basically crunch it to know exactly what's in each ETF. So we know exactly if there was a rebalancing yesterday and they sold out of one stock and put in another stock. We have the fresh baskets overnight. So that's like a manual intervention in the morning to load all the different compositions in all the different ETFs. But once the market, like once the strategy start at 9:15 and starts, like putting bids and asks and putting a market to be ready for the open. Once the open starts, I would say the only manual intervention would be if the market maker wants to tighten the spread a bit or widen it, depending if it's very volatile or add more size. If he knows somebody's coming in to buy 50,000 shares and he's usually showing 25,000 shares, he'll show like 50. So these are like manual intervention in the algo program, the system. But if the question was asked because somebody once tried to pay offer and buy an ETF and the quote move, that's not us moving it. We're not fast enough.
You guys trying to.
We're not fast enough. First of all, second of all, I mean, we're quoting 1,400 ETFs. So
well, that was kind of like a follow-up question to that. Is like you said, like that kind of manual process of like loading the baskets into the system so that the system's then ready to roll. Is like you guys are quoting how many ETFs? Like that's a lot of different baskets to be looking at. So
and then once you load them, you sort of have to check them. So we have multiple checks because sometimes if a basket is loaded and there was a stock split and it's not well done in the PCF, well then I mean you're quoting with twice as many or twice less shares versus the price, and then obviously your model is not good, and then you're gonna get picking off by our great competitors, the other market makers.
That's right. Let's look at these cameras after that one.
Where's the camera?
But and actually, you know what? Like we chatted about that with Patrick as well, right? It's like you have to be very precise on the valuation of those baskets and pricing it, because it is a highly competitive market, and that's what should make Canadian investors like comfortable that of the role that you guys play, is because otherwise, there's somebody else right across the street that's going to take advantage of it. So it's a very efficient marketplace from that perspective.
It is. And I mean, if we see one of our competitors trying to make a penny and a half or 2 cents on a spread, we will obviously come in and try to make half a penny or a penny. Because for us, it's a game of volume.
Absolutely. Yeah.
So like we quote so many ETFs, the ones that trade the most, or the ones that we're designated broker on or primary market maker on, we will be quoting them as tight as possible, because the issuer, if we're quoting them too wide, is going to say, my model says it should be 2 cents. Why are you 3 cents? And we have these back and forth conversations with issuers all the time. But it's a very, very competitive market out there. Yeah.
No, that's very good. Let's get to our second question. Should you trade ETFs like stocks? And maybe I'll add a little bit of color to that. Is I think this question comes up from investors because of the nature of the way that they feel like they're trading. Obviously, these basket or like the ETF versus a stock is very similar concepts. Obviously, the way that you're doing it on your platform or how your advisor's doing it on their end.
I would say even more now, because now there's ETFs of stocks.
Single stock ETFs.
With like leverage or a covered call on it or whatever it is. So back then it used to be like an index, and but you
set it, forget it.
But you could trade it. I mean, if your goal is to buy it and sell it once you're up 2%, if you do buy any core equity or anything like that, and then you just want to realize 2-3% and sell it. But ETFs are very, very liquid, obviously. They're traded. The spreads are tighter than ever, so you could obviously trade them like stocks, because they're open at the same time.
And it's interesting. So I guess maybe piggyback off that kind of answer is I feel like there's been periods, or maybe there's certain situations where the ETF is actually more liquid than the basket or the underlyings. Like,
so
I don't know if you could provide like maybe an example of that, or like situations why that might happen. Like
this happened exactly
like March 2020 seems like it was like maybe a case a little bit for like fixed
I'm old,
income.
so I forget dates, but
like the fixed income period during COVID.
Exactly.
But I don't know if there's other
basically what happened during that period is that some fixed income ETFs had bonds in there that weren't even trading.
Yes.
So when they strike the NAV at the end of the day, they basically use like a bid ask, and they take the mid, and so the ETF was trading much tighter than the actual underlying basket.
Yeah.
So the market makers throughout the day, they're fed electronically quotes for the bonds, even if they're traded OTC, because they get runs from all the different fixed income desks. And they were using these prices to quote. But then after buying, like for corporate bonds, for example, ETFs, after buying a large chunk, they would try to hit those prices that they were being fed, and basically the desks were no bid. Yeah. So the ETF was still very, very tight. And by at the end of the day, you're basically creating and redeeming at NAV, and then you realize that the NAV was completely dislocated from the ETF price. But I mean, that's an example where the ETF was still trading a lot, and basically that's what was indicating where the prices of the underlying basket should have been.
I bring that up because I feel like there's a misconception that that's a disadvantage of ETFs, right? Because you're disconnecting from the NAV, say, where maybe a fund is going to be stuck at that NAV.
Well, try to trade a bond,
and that's
using your phone during a period of crisis, and then basically no one's going to answer. So at least the ETF is giving you liquidity.
And that's exactly the point, right? It's like, it might be, there might be a sizable spread, but like at least you have liquidity. It's better than no liquidity.
Exactly.
And if you had that single bond in your portfolio and you're trying to get rid of it, to your point, and the beauty we'll see in a couple of weeks when the Fed steps in. And
that's exactly what happened. The beauty about ETFs is that there's one platform where everybody meets, and that's on the exchange. So you could be interacting with a market maker, or you could be interacting with institution, with another retail. So everybody's at the same place, and that's what's creating that market. Like sometimes, if the ETF is slightly dislocated from where the basket is, we have people that are
they're after you guys right away.
But they're like, okay, I want to sell 200,000 shares, and our model is actually a penny lower than where a big institution is bidding. So we'll tell them, well, this is a great price, you should take it. And we're there to show where the model is showing like the fair value, and is that a good price? Is that not a good price? Are we going to take it? Are we going to hedge it? And so on. But I mean, at least we're providing color, and we're setting the goalposts. Like this is what the bid is fair. This is where the offer is fair, and then feel free to put a bid mid-market and hope for a retail, like we call it a natural seller.
A market order, and
somebody
in there.
That's it, exactly. But I mean, at least we're providing the fair value bid and fair value offer on the.
Okay, I'm gonna mess this up a little bit. We're gonna skip the next question from the internet, but I want to get to, because you just mentioned that setting the goalposts, and then you might get picked up by somebody who's placing a market. Can we just spend like a couple minutes on like what are Fred's best practices in terms of trading ETFs? Like, might as well chat about it now, because I think like that was.
Yeah, sure. I mean, it always depends on the size of your order.
Yeah.
But I would say, like, general rule of thumb, avoid the open, because I mean, as I was saying earlier, when we put the quotes, the program sends the quotes for the open. If retail advisors have market orders, buying or selling, some of the U.S. stocks, the quotes that we're getting are not very accurate pre-open. We could see like even in Canada, like the quotes you're seeing, you're not sure you're going to be able to trade at these prices. Once the market opens. So the ETF is always a bit wider. So if you're putting a market order, we will try, obviously, to open it at the fair value that we see. But the fair value that we see might be slightly off. So I would say, like, avoid sending market orders and
generally, but especially
exactly. Like we speak to the TSX and CBOE, who are the two listing companies, and they call us with the tickers that we're designated broker on. Every morning at 9:25, and then we go through a list, because like the 2 weeks ago when the market was up, we're down 7-10%, and then we had other sectors that were down 30%, So we're basically going through, ticker by ticker and saying, no, this should open here. No. But
really, that's
yeah.
That's interesting.
So we do our best with the exchanges to open all ETFs at the fair price, but some can slip through the crack, and it's unfortunate. But avoid trading on the open, avoid market orders, I would say, at all times. If you think your order is a bit bigger than a normal order, call it 200,000 shares or something like that, and that liquidity, you don't see it on screen. Like maybe break it up, or call your retail desk. Call your firm's retail desk. They all call us. Like we trade with all the retail desks on the street, talk to. The issuer. If you're thinking of a trade, maybe you want to put in $20 million into an ETF. Talk to the issuer, the capital markets people, your wholesalers, and then they'll call us, and then we'll guide you into what the best practices to.
We try to screen for you guys as well, right? Like, or help at least some of the definitely the advisors we work with. It's those are all great tips. It's we always kind of get these same kind of rule of thumbs. Like, I feel like it can avoid a lot of situations where parties are unhappy, right? Like if you follow those couple steps, and you're limiting your chance of coming out unhappy with a transaction on an ETF for the most part.
If you're sending like limit orders or market orders, even if your system only takes market orders or whatever, know that we're there, and we're providing liquidity, and it's better to be safer than.
Better be safe than sorry. Let's do one last question from the internet, then we'll get to. I've got a few questions for you as well, so we're going to make sure to get to those. Okay, maybe it will be two. There's a couple good ones in here. What industries or themes do you wish had better ETF options? Like, is there a part of the market that you think? I mean, I think it's a tough question because I feel like we got an ETF for absolutely everything now. But is there something? And it can be maybe a short answer, but I guess I think it's a good question, because I feel like if you go back 10, 15 years ago, there'd probably be a lot of the stuff that we have now that could have been answered in that question. But it's getting pretty deep.
It is. I would say there are enough ETFs for every sector.
You guys don't want to quote another 2,000 ETFs.
We've been in discussions with ETF issuers that are in the market right now, and some that wanted to enter the ETF market, and they had these IDs and stuff.
Complex.
But the first thing that's important for a market maker is something needs to be listed. Yes. Or there's got to be a way for us to get a listed quote in there somehow.
You need an input into the model, or the system,
even
right?
if it's a proxy or something. But I mean, we've had stuff thrown at us, and it was we brainstormed. It sounds
great on paper.
Yeah, exactly. and there would be demand for it, but I mean, if the market maker, because the market maker basically you price risk. The least info you have. Well, then
the more
obviously
risk you're taking.
You're going to be a bit wider, because if you don't really know what's in it, by the end of the day, when you go to create or redeem and you realize, the market's here, not here. So the more info we have, if everything is provided to us and everything is listed and everything is liquid, well, then we're going to have the tightest spread possible.
I like that last comment, because one that we get often is your ETF, or a certain ETF, not your ETF, and it doesn't necessarily have to be a Fidelity ETF. It could be any ETF. Realistically, it's just, your ETF is trading wide because it's got low volume and doesn't have a lot of AUM like that. Yeah. So when you launch new obviously now I think we're up to 30 billion in assets under management. When you're launching a new ETF business, or you're launching new products, sometimes it's okay, it's only secondary liquidity is one thing, but to your point that you just made there, right, is if you're trading very liquid, very transparent, securities, that should be the number one driver of the cost of trading, right?
Basically,
please.
No, that's exactly it. But if the bid ask is wide and it's not volatile, it's really because this is exactly what it's worth.
Yeah.
Like you take the weight of all the stocks in the basket times the price, that's the bid, you take the offer. So if a competitor has the exact same product as you and the spread is tighter, maybe it's just because somebody, for example, if it's 10.02 to 10.05, the bid ask.
Yeah.
If for example the competitor has somebody that wants to pay 10.04, well, he's gonna go 10.04, and then you look, and then his product is a penny wide, but yours is 10.02 to 3 cents.
Yeah.
So the fact that people are actually coming in, not those natural buyers and sellers, that's what tightens the spread. It's not the market maker that's tightening it, because if you sell it at 10.04, you basically lose money, because the market maker,
your model's telling you it's 10.05.
Yeah.
Somebody's willing to get out of that position.
The market maker, when he's offering at 10.05, is because he will, once he sells the ETF, especially if it's on the algo system, when we sell the ETF at 10.05, in a microsecond, there's a basket that's sent, and then we buy all the underlying stocks at 10.05, at 10.04 and a half, for example, and then we lock in that half a penny or something like that. So that's basically the game of a market maker, is to provide liquidity, and try to buy the stocks at the price that he sees. And in a volatile market, if we do a bigger block, for example, 1 million shares of whatever, we sell it at 10.05, and then there's a tweet, or there's a news, or there's something. Well, then when we try to go and buy that basket, we're not paying 10.05, we're paying 10.05, 6, 7. Yeah. So okay, we lost money on this one. So then we gotta make it back somehow, So we wait for the next transaction, and then we try to buy and sell at the fair value, and then you do that throughout the day, and that's basically what market making is. But the fact that the spread is wide is not because the market maker is trying to make 3 cents or market maker is trying to make 5 cents. You always have to open the hood. What is the underlyings?
What's going on?
Like preferred shares, super wide, illiquid. So if you see a preferred share ETF at a penny wide, it's all retail. It's all retail interacting with each other. No, we're wider, again, like setting those goalposts. Okay.
All right, well, we'll leave it at that for answering the internet. I'm going to get to asking some questions to Fred and myself, and we've got a bunch, but we're going to go for another about 10 minutes. So we'll expand on some of these, but like Fred, I know we've been chatting here for a while now. I feel like we've answered quite a bit of nice questions from our internet audience, but maybe just taking a step back, like what is the day in the life of a market maker, or in your case, like sales as well? Like what does that look like going into the office? Obviously, we talked a bit about some of the guys, but maybe a bit more.
We wake up at 8. We go jogging.
That's not too bad.
No,
you don't have you have kids? You're a bit older, because I get up significantly earlier than that.
19 and 22. By the way, that was the joke. Waking up at 8. Now we usually get to the office between 7 and 8. Depending on your role. Yeah. 7:30. Some guys are actually coming in at like 6:30, especially the ones that are crunching the
the ones that are starting to fill up the.
Call it 7:30. So some mornings we have like these meetings and stuff, like planning ahead. And
if there's like huge headlines the night before, is that like, hey guys, maybe we gotta because you're going to expect some volatility at the open, for example, or things like that.
Those market orders, especially, like where people, it's time to buy the bottom, So we know we know it's going to be more challenging. Well, something we always hear is we'll get back to the day in the life of.
Okay.
It's pretty boring. It's pretty boring.
It's a conversation.
It's pretty boring, so I want to move away from it. No, but it's like there's volatility. The market makers are moving or getting out. Like we do see it with some of our competitors.
Oh, okay.
but I mean, for us, the model itself, if it's still liquid, if the underlyings are still liquid, these are the days where you want to be there, and capture more volume. Yeah. So if it's very, very choppy, meaning lots of, up and
start down. And the Fed announcement goes way back up.
Our spreads will not necessarily be wider, but the size that we're posting, instead of being 50,000 shares on the bid and the offer, we might reduce that, let's say, to 25,000 shares, just because you don't want to do a big block, and then by the time you try to hedge it, it gets choppy, and then you can't hedge at the price that you're seeing. But I mean, we will stay in there, you know, unless the futures are limit down.
Yeah.
If there's
Well,
issues,
it's different. You got circuit breakers
exactly.
and situations like that.
Or if there's issues with quotes, like we had 2 weeks ago, like, you know, the TSX, we were having bad data.
Really?
Or
I didn't.
Omega, Chi-X. There's like 10 marketplaces in Canada. So sometimes if one has issues, the quotes get crossed. So obviously our models are like, whoa, what's going on, you know?
Little red flashing somewhere.
Yeah, that's it. It's like a parameter. So,
Okay.
yeah.
Okay. Rest of the day, so just the morning? No, I'm just kidding.
Yeah, that's it. Wake up at 8, go back home at 10.
There you go.
Yeah,
The
programs are
working.
started. No, so once the market opens, like I was saying, speak to the TSX, the CBO, everything opens, then it's discussions with advisors,
Issuers,
retail desk,
kind of
quotes coming in. Like we get hit by emails, Bloomberg chats, RFQ. It's all the market makers. They get a pop up, and then you put your price, and then you basically compete with the whole street, and then you win the block, or it goes and it trades away. You know, so it's all about trading, making sure the models are as tight as possible, capturing the volume, making sure the risks are good. You know, you didn't do a block and you forgot to hedge it. So lots of red and green in the screens, and interacting with the salespeople get calls. Where can you do this? So we talk to the traders. The traders basically give us a price. We trade, and then they manage that risk. You know, so sometimes they hedge with a proxy. They hedge with a US ETF. At the end of the day, they have to unwind this. Some ETFs have 11 a.m. FX. You know, so then it's all these different things. Some ETFs are T-1, meaning you trade today, but you can only create or redeem the next day. So there's all these different things that need to be taken into consideration.
Seems I almost regret asking that question. You don't make it sound that easy, so it's good. It's always interesting. Like I said, like I always learn stuff out of this, and I think. For investors, advisors, like you learn all these, you kind of hear it once, but you need to hear it like 6 times to, I think, grasp the amount of stuff that's happening behind the scenes. Because when you're clicking you're putting your order in, and it gets filled, and it's like simple. That's it. But there's a lot more to it.
But I mean, we have a big desks, and we have guys specializing in all different asset classes. A crypto guy, you know, we have the bond ETF guys, the equity, the international, the pref, you know. So it's the beauty of having a big desk.
Big desk,
with, you know, good, professional, smart.
It's good. The best and the brightest. Yeah. Okay. So I guess my next question is, like you mentioned earlier, is when you're pricing things out and you're thinking about the underlyings, and you're like, one of the main considerations, maybe the most important, is like figuring out how to hedge your risk. So like, how do you go about hedging your risk to the trades that you're making? Because once again, like you're executing that trade, but you're getting that at the end of the day. So you need to find a way to protect yourself to a certain way.
So basically, the way that it works is that when we'll take the example when we sell an ETF, there's a basket that's launched, and then we buy it. So for example, we do this trade at 10 a.m. On the equity underlying ETFs. 99% of the time you sell the ETF, you buy the exact
basket,
because that's the basket that you will need to deliver at the end of the day to the issuer.
Might as well get the whole thing right now.
Why trade half and then have like exposure? But I hear some people do it, you know, they optimize baskets and whatever, but we're more in the business when you trade 1,400 ETFs, hedging it at all, delivering that basket.
The way it was intended to be, basically.
I mean, everybody's got their different models, obviously.
Of course.
We're not going to give away the
No. Nobody's secret sauce. No.
But for fixed income, it's a bit different, because obviously you're not going to sell...
Well, you're sampling to a certain extent.
Yeah, you're not going to sell a block and then start buying bonds like right away, you know. So it's more like hedging directional risk, and then figuring out, okay, you know, when will I actually go and trade the underlying bonds? And then you work with the issuer. Sometimes there's a custom basket, meaning it's a smaller basket from, let's say, a universe of 2,000. And then you work with the issuer, and then you agree on a basket. But I would say 99% of the time you're hedging something, like if you sell an ETF, you will hedge if it's the interest rate risk or the full basket by buying it and locking in that spread that you're hoping to make. And then throughout the day it's managing,
maneuvering that risk
exactly, and the positions. You might finish the day where you're flat on an ETF. In the morning you were selling, for example, a particular ETF, and then in the afternoon people were selling that same ETF to you. So at the end of the day, you're basically flat, and you don't even have to create or redeem. So it's really,
so you've been delivered the basket that you were intending to buy, basically, or you were buying intending to buy.
So your risk is flat. So it's really at the end of the day where you're gonna make the decision: am I creating or am I redeeming? Obviously, unless you do a huge block at 10 a.m., you'll need to do something. But I mean, that's pretty much the process.
Okay. Would you guys, and maybe not you guys, but like market makers in general, like ever take a risk of like, let's create units in anticipation of demand for a certain ETF, like in the sense like you think you can get it now better price than tomorrow, and I can deliver that basket that's probably gonna be worth more tomorrow.
Not in the concept of market making, but obviously if we think that a sector might go up, well, we could do like a prop trade and then on the side and just buy that sector, but that's a different group that does that. Different group. Yeah. Because obviously one thing that's important to know is you don't need to have units to be able to, when you sell the ETF. Like some people are in this market and they have zero position on any ETF, and they're buying and selling. Yeah. And basically if you end the day and you've sold 500,000 units, if you have that agreement with the issuer, you can just go and create units. You don't need to hold an inventory to be able to sell it. True. It's really something important to know about that.
Okay, I'm going to take us to a bit of a different spot, and we've only got like a couple minutes left, but I wanted to ask this one because you've been in the industry since basically like at least the real kind of growth part of, because I mean obviously everybody always points out the first ETF was launched in Canada 93. It wasn't the TIPS 35 like in 93, and that was early 90s, like 93 I think or something like that.
Yeah, it's the first ETF in Canada.
So let's not talk there. Let's say like I don't know, in the 2000s, like was there like a turning point for you where you noticed like, oh, this business is like as much on the market making side as well, just like for issuers, like the ETF business in Canada is going to be what it is today? Like, was there a turning point of an event or a type of product, or is there something that you said like, oh, looking back?
I don't remember the exact date. Was it 2010 or 12 or something like that? But probably, I think we started ETFs in 2008-ish.
Yeah.
Call it maybe 2010, 2012, when the factor-based ETFs, when it just went away from like the core,
just the market cap weighted index stuff.
Exactly. The following an index, type of ETFs. When these factor based ETFs started, and then when the institutional usage also of ETFs went, I believe they started using fixed income ETFs. There was a big push by a couple of the bigger ETF issuers.
Just buy the Canadian bond market and keep it simple.
And that institutional usage, and then the more funky products that started after. Then we realized that it wasn't just like index based.
This vehicle is
this vehicle can be pretty much on anything. Obviously the leverage up down were already there, so you could see that like derivatives based, swap based, and then I realized that this thing had some wheels.
The institutional component is always so. Once again, I love that report that you guys send out every month where I get all my industry data. It's like nobody really, and maybe it's an estimate, but like in terms of like say the total AUM in Canada for ETFs, like there's estimates for the different groups of like who holds what, but like what maybe like you have a lens into that because you guys are interacting with all the different types of ETF investors. But if you were to break it down by like direct investors, so like discount brokerages or like the kind of do-it-yourselfer advice channel, and then institutional, like which like
I think it used
like
to be
proportionally.
I think it used to be like, let's say DIY, and then retail advisor, and then I think it used to be like maybe 5 years ago like 10%. Retail, I would say maybe, I don't know, 60, and then what's left, like 30.
Yeah, institutional 30.
But now I think in like the DIY versus retail, I think it's close to 50-50.
Oh wow.
Yeah. So and then that bucket, I believe, is it 30 or 40%, and then institutional 60 or 70. That's what I think, but
really?
I'll
we won't
I can send you these.
We won't put your name down to say if this is wrong.
But I know that the DIY has grown.
But still, then it has institutional then to a certain extent.
Yeah, institutional.
If it's a bigger chunk.
Yeah, but it's bigger size, obviously. In terms of AUM.
Yeah.
But yeah, I mean it's that's
interesting.
Yeah.
Let's do one more question, and then we'll let you go. And this has been awesome. It's been really awesome. I've really had a good time doing this.
Same.
You just got back from the Exchange conference in Las Vegas, which is, I mean, and once again, I think you came back yesterday, so just you being here is great. That just for our audience, just those maybe don't know, it's more of an industry thing. Obviously, it's a huge conference where market makers, issuers, industry experts that are from Bloomberg, CNBC, and all these different like news outlets as well. Like everybody just convenes to have like this big ETF conference in the U.S. once a year. And so Fred was there, and I guess my last question is like, is there anything that like a theme that came out or something that came out of it? Or I know you guys are obviously busy with like meeting your clients, but is there something of note that
I don't remember much from the last 4 days, to be honest.
No. It was, they should stop. They should not host this in Vegas or Miami, which is where it was before. But yeah.
Actually, people don't like the fact that it's in Vegas, because they had a taste of how it was in Miami.
Yeah.
It's much
different.
easier to walk around.
For
Vegas,
sure.
you're always stuck in your thing. But I mean, for us, there's two types of people, that go to conferences. The one that go to the beach or the pool in this case, the whole time, and then the ones that actually go and take notes, and watch all the panels. We're more like in the middle. Some of us go.
Half the team's at the pool.
Some people go and they learn about ETFs.
Absolutely.
And I know everything, so I don't need to go.
So you're on the pool.
But it's for us. It's mostly meeting our U.S. Market makers that we deal with, obviously, because we trade a lot of U.S. ETFs.
Yeah.
And then meet potential U.S. clients. So we're always in meetings, and it's lunches and dinners and all this these beautiful things that come with this type of work.
Not like I don't know, like a new and like a crazy thing that you're like, oh, maybe this is.
Well, I heard that the content was much better.
Okay.
So because it's important to have like people that are not allowed to say things, but like most of the people,
share things that
I
maybe
go to the derivatives conference, and everybody wants to learn about like how can you create like better returns and alpha and all that stuff. And then people they start and they say they have a disclaimer, and basically they can't really talk about anything. And what you don't want is people also just trying to sell their products.
For sure.
So I think there's a mix of everything, but I heard it was
okay.
The content was much better.
All right. Well, I think we're going to leave it at that. Thank you so much for your time. It's been awesome, and I hope we'll get to do it again. And I know you guys have been great partners to us, and same, obviously, vice versa. So it's a good relationship, and we're happy to produce content when we can. So just to wrap up the show, just once again, a reminder, thank you, everybody, for tuning in. You can catch all of our previous episodes on your favorite podcast app, on YouTube. As always, please submit your questions to us online. Like as you saw today, we answered a bunch of different ones. Always a pleasure, and we'll see you next time. Thank you.